Investing in stocks. How do I pick the right ones? 4 things to look for. Picking the right stocks to invest in is an important thing to consider in order to prevent our money from going to waste. We wouldn't want to risk our hard-earned money on any investment, so it's a must that we know how to distinguish between a bad investment and a great investment. But before that, welcome to this video, awesome people. This is Finance Boss and I'm here to share with you the 4 things to look for before investing so that our money will round up to what we expect and hope for. Also, don't forget to like, comment, share, and subscribe to my channel for more awesome content. Number 1. Price. So you found a company that you understand has a moat and it's profitable as measured by the return on capital. But you don't just want to buy it at any price. Even the best investment becomes a horrible investment if you pay too much. So this is where the PE ratio comes in. The PE ratio is a metric that tells you how expensive or cheap a stock is relative to the earnings it generates. Here's how it works. PE ratio equals the current market price of the stock divided by the most recent reported earnings per share. That's why when you talk about stock price, you always want to look at it relative to earnings. Generally, when you're looking to invest, you want to buy stocks with low PE ratios, especially if its PE ratio is usually higher but it drops for whatever reason. That means the stock is trading pretty cheaply relative to where it usually is, and it's probably an amazing bargain. PE ratios are super useful to know about because when you buy something cheap, you reduce your risk by a lot. Like if you bought something cheap at a low PE ratio, there's not a lot of room for it to get much cheaper, right? Whereas if you buy something expensive or a stock with a high PE ratio, there's a higher chance of it going down and it's not safe of an investment. Number 2. Competitive advantage. This is called an economic moat. This moat is a company's ability to protect its profits and its market share from competitors. Never invest in stocks without a moat because for long-term investing success, you need a company to be around in the future. And the only assurance that the company will still be around in the future and that your money won't be lost is its moat. It's a competitive business environment out there. So you want to invest your money with companies that have really wide durable moats. Coca-Cola has been around for so many years, decades, and they have an unbelievably strong moat. There's tons of competition making generic copycats of Coca-Cola drink. But because of Coca-Cola's iconic brand name and its worldwide distribution network, they've maintained fat profit margins for the last century, despite there being all kinds of Coke imitation drinks out there. So moats come in many different forms, and Coca-Cola's moat was due to brand name and economies of scale, so they had 2 sources of moat. Other types of moats are trade secrets. For example, when a company has a patent or some sort of secret way of making a product that their competitors can't copy. Another source of a moat is network effects, where everyone is using that product, and because everyone is using it, it just makes the value of that product even more valuable. A perfect example is Facebook. Because everyone else is on Facebook, you also want to be on Facebook because that's how you stay connected to everybody else. And because everybody's on Facebook, everybody needs to advertise on Facebook, and so on and so forth. So that's what you call network effects. Another type of moat is a toll bridge moat. So back in the day, you can think of a traditional toll bridge where in order to get onto this road, you need to pay that toll. So an example in the modern world is Google because they're the #1 largest search engine in the world. If you want to advertise and reach all those people who are searching on Google, you need to pay Google to advertise on there to access all those people. Another example of a moat is a cost moat, where that company has the ability to have lower cost than all of its competitors, so that allows it to either sell at a lower price or maintain bigger margins. So an example of this is Walmart. Walmart is such a big buyer that they are able to demand lower wholesale prices, which in turn allows them to charge lower retail prices and also maintain good margins. So as you can see, there's a lot of different ways to have a moat. Toll bridge, lower cost, network effects, a brand name, a brand presence, economies of scale. So before buying a stock, you want to always ask yourself, what type of moat does this company have? And then, you also want to ask yourself if it has a moat. how durable is this moat? And if you can't think of anything, then chances are it doesn't have a moat. And if that's the case, you should cross the stock off your list and move on. Number 3. Profitability. Before you invest in a stock, you also want to consider, is this company profitable? The best way to measure profitability is with the metric called return on capital. Return on capital is net income divided by invested capital, and it's expressed as a percentage. Return on capital is important because it tells you how good a company is at generating profits given a fixed amount of resources. Yes, profit is great, but what's more important is how much it costs to generate that profit. So companies with a high return on capital do a lot with a little, and companies with low return on capital do a little with a lot. So if you're considering a stock with a high return on capital, it probably means it has a strong moat, and you'll be getting a lot of bang for your buck with that investment. So as a rule of thumb, you want to look for a high return on capital when buying a stock. Number 4. Debt. Before investing, it's very important to consider how much debt a company has. Most companies have debt, so although debt isn't necessarily a bad thing, it's a double-edged sword. As long as a company has enough cash flow to pay the interest and principal on its debt every month, then debt is just part of running and growing a healthy business. Sometimes, you need to borrow money to grow. But what you don't want to see is a company with boatloads of debt on its balance sheet, and it owes so much that it would take forever to get out of debt, or it even borrows money to service its existing debt. These are red flags you definitely want to watch out for. Here's how you assess debt. So, you look up long-term debt and free cash flow, and you want to divide long-term debt by free cash flow. And I call this the debt payback number. This number basically tells you how many years it would take for a company to pay off its long-term debt with its cash flow, and a good rule of thumb is 3 years or less. You don't want a company that's going to take like 10 years to pay off its debt. Highly leveraged company or companies with a lot of debt are risky because if for whatever reason there's a downturn and revenues fall for a while, that puts the company in a very shaky territory because its debt payments are fixed while its revenues are variable. If a company can't make its debt payments, it's going to have to declare bankruptcy, and that could mean the stock price goes to zero and you lose your entire investment. So, if you just stick with conservatively financed companies, then you'll be fine. And there you have it, 4 things to look for in a company before investing. Make sure to consider these things so we could all build our investments in the future. If you like this video, leave a comment below on your thoughts. And don't forget to subscribe to this channel for more awesome content. This is Finance Boss. Have a successful investment. Bye!